Hello and welcome. You are watching KYC. I'm Harsaita, and on behalf of the entire KYC team and on behalf of the entire of NDTV Profit, we all wish you a very, very happy Independence Day. Of course, we're Indians, we're proud of that, and yeah, just spelling it out. Anyway, we'll start off with the KYC today, and it's a stock which has done extraordinarily well for investors but has delivered an outstanding set of numbers as well. The Q1 numbers really stood out. Very little in terms of criticism that one can pull out where a Muthoot Finance's numbers for Q1 is concerned, and therefore deserving and warranting a KYC to try and understand whether there is still some bit of re-rating possible on this one or not. And that's my first question. How much of the growth is driven by the rise in gold prices? They've done a 40% loan growth in the gold AUM. That's what's driven the overall AUM higher. And I want to therefore understand whether some part of this or a larger part of this is driven by gold price rise. The guidance, viewers, mind you, was that they will do a 15% growth in FY26. They have done 10% QOQ in Q1, which means that there's very little left in terms of growth to meet and beat that guidance. Very likely they will beat that guidance, and therefore I'd want to know whether the growth expectations for FY26 are now revised. We've seen a couple of analysts come out and talk about a 25% growth possibility in FY26. I'd want to know whether there's a formal change to the guidance or not. The third piece is therefore, is this a sustainable kind of performance? This beat across all parameters, can this sustain for maybe another 1, 2 or even 3 quarters? And if that is so, is this a blue sky situation, or can we see a more sustainable kind of a performance where the type of performance that we've got in FY26 is concerned? Can we get used to that or not? Or is this just a pure blue sky quarter and we'll start to see normalization as early as Q2? Because that will mean that some bit of the reaction today may not be fully warranted. The fourth piece is with regard to margins. Margins are aided by credit rating, or is it falling on the back of, or is it rising on the, or is it aided by the falling repo? What is it, and how much can I attribute it to each of those parameters? Because we've seen a couple of credit rating agencies upgrade the counter, so maybe some of that also rubbing off on the margins. I'd want to know that. How should one look at yields? The gold lending business is unique. When you have a customer who will come to a gold lender, he'll come in and he'll give you loans, and he'll give you the gold as a lender, and you'll give the borrower a loan, right? Now the value of the gold goes up, which entitles the borrower for a larger loan amount, right? But the rate largely will still likely be the same, and that's what I'd want to know. Whether the rate is also actually tweaked when the loan rates go up, and when a borrower comes in and borrows more money against the same quantity of gold, can the rates remain the same or can they be tweaked? Practically, how does Muthoot do it? And therefore, where do yields go as a result of this? Are they benefiting from that, given that yields have remained on a higher note and the repo has come off sharply post that? Credit costs. What should one make of it, given that they are undertaking diversification? Can we expect the kind of credit cost number that they've clocked? I know probably we'll analyze the more standalone numbers, and maybe at a console level the credit costs are higher and most of the other business are loss making, but I'd want to understand what the strategy is with regard to the diversification as well as the credit costs on the back of this diversification. So that's my 6th point. My 7th is with regard to the possibility of an upside surprise on ROAs. Now, this could be a positive for FY26, and sustainability of that for FY27 is also something I'd want to know. So all of that is what we'll try to explore today on KYC. It's a long one, but let me start off with the parameters before the parameters, what the company does. I'm going to first start off with a quick overview. It's India's largest gold loan company. It's got a 135-year legacy, headquartered in Kerala, has nearly 5,000 branches, customer base of almost 2 crore, larger focus on rural and semi-urban markets is what it has. In terms of product, the core product is gold loans. Let me illustrate how much of gold it does. Around 1.3 lakh crore is its total book size, out of which 1.2 lakh crore nearly, or apologies, 1.12 lakh crore nearly is gold loans. And Muthoot standalone is around 1.2 lakh crore. So when you're looking at it in the overall scheme of things, 80% plus is gold loans. And the growth there is what is driving the overall AUM growth, understandably, because just the size of the gold loan book is extremely large, and therefore no matter how fast some of the other segments grow, gold loans will really dominate in terms of the growth number. And therefore a 40% YOY growth, you can't do it without a gold loans, and therefore that's how it stacks up. In terms of what gold loans are all about, well, they're fast, flexible, short-term credit. I explain as to how a customer comes in, gives in the gold is valued 70% or below of that gold value is given to the customer as a loan. Broadly, that's how the business model works. In terms of others, well, you have personal loans, you have business loans, loans against property. There's money transfer and collection services. They do insurance distribution, affordable housing loans, microfinance loans, vehicle finance loans. But broadly, it's microfinance, housing finance, and unsecured. That comprises of maybe 10% of the book of a Muthoot. Outside of that, pretty much a larger chunk of the loans is gold, which they give out. In terms of the core model, I did explain this model, but let's quickly have that. Customer gives gold as collateral, he gets cash, the branch network collects, evaluates, safely stores the gold jewelry, and if the customer defaults, the gold is auctioned to recover dues, and therefore you likely not see customers defaulting because the value of the gold will always be larger than the value of the loan plus interest that the customer owes. That's broadly the way in which it functions. Now let me start off with the key metrics as well. Try and explore what are the metrics we look at. We look at income statement, balance sheet, asset quality, operational metrics, shareholding, street cred, street coverage, and valuations. We'll cover all of that, we'll cover all of that in terms of the key metrics where a Muthoot Finance is concerned. Let's start off with the income statement, and I'll first look at Q1. And Q1 is essential because the kind of performance they've delivered in Q1 is extremely strong. You'll see it on your screen, 51% net interest income growth, 20% sequential. Again, you'll see that your interest income is rising much, much faster than your interest expense on a sequential basis. That's what's driving that growth higher. And that, along with the 10% QOQ AUM growth, is just giving a new fillip to that NII absolute number, which is what is playing out on operating income, which has gone up by 30% QOQ, 63% YOY. Also, your OPEX hasn't inched up in a significant fashion, and therefore your OPEX to assets has come down. We'll look at those metrics as well, but OPEX to assets has come down, which is helping the operating income number. Your provisions largely have come off, you could visibly come off, and therefore you're seeing that surge in profitability, 90% growth in terms of profit after tax. These are standalone numbers. But now let's zoom out, as we always do on a KYC. We don't look at it from a 1-year lens. We look at it from maybe a 3-year lens. And that's what you're seeing in terms of the 3-year picture up to FY25. So why Q1, FY26, very solid numbers. That's the number that we're looking for in terms of the FY25 number. The total PAT standalone in FY25 was 5,200 crore. They've done 2,000 crore in Q1 of FY26. That's why you're seeing the kind of reaction you're seeing. But that's how it's actually played out. And what you're seeing over the slightly longer term with a slightly zoomed out lens is that this business is otherwise not grown at a very, very sharp pace as some of the other NBFCs have grown. And understandably so, because it's tilted towards gold, and therefore gold prices going up is certainly one of the metrics that you look for when it comes to growth. It's also intense competition, higher yields, and therefore you've got some of these banks coming in and trying to disrupt the marketplace. You've seen an SBI come in aggressively with regard to gold loans, on the larger banks coming in and trying to build a gold loan book. And then you have some of the other NBFCs as well, Capri Global, etc., which have come in and tried to disrupt. And which is why you're not seeing the kind of numbers that we've seen in Q1 FY26. And therefore, we'd want to understand what's changing. But that's broadly the case. But FY24 to FY25, we've seen very, very good growth. And that is also to a certain extent because of the way the gold price has moved. That's one. And second, it's also because of competition coming off slightly in the gold lending business. Both of those have aided some of the numbers where FY25 is concerned. But the 3-year view, not looking as impressive. We'll be cautious on this one. We'll give it a neutral where the income statement is concerned. Let's look at the balance sheet though. And the balance sheet, again, what you'll see is that the growth has been extremely back-ended, but there has been growth and the growth has been strong. This is, of course, Q1 FY26 numbers. Let's look at the 3-year numbers as well, and that will give you a better picture. The growth has been good. It's been around 30% on a 3-year CAGR basis, and therefore it's positive where the loan asset growth is concerned. Also, your capital adequacy is fairly healthy. Both of those metrics adding up fairly well, but the growth has been back-ended, which is a maximum part of the growth has come in between FY24 and FY25. And that's why the tilt in the 2-year CAGR is more back-ended than anything else. That's something you want to keep in mind as well. But we've given this one a clear thumbs up. Let's talk about asset quality. Very, very stable where asset quality is concerned. You've seen NPA ratios largely been between maybe the 3.4 to 3.8% range, so it's fairly range bound. Your net NPA or your ECL percentage also has been fairly range bound, so no complaints there. We've given this a thumbs up. Of course, it's a risky business, but the stability with regard to the way in which assets have moved is important. Now, mind you, when you are looking at a lender, you don't necessarily get worried if the NPA ratios are high. You get worried if the NPA ratios fluctuate too much. That's what should worry you. If the NPA ratios are high, but if your margins are very, very high, that should take care of some of the credit cost. That's the better way to look at lenders. And that's why, even though it's a 1.5% kind of ECL percentage, I wouldn't be too worried about it. Simply from a perspective that some of the other metrics also matter when you look at asset quality, and that's broadly how one looks at it. So we've given this one a thumbs up purely on the basis of stability. Now let's look at some of the key metrics. The margins, again, largely stable across cycles, 11.4 to 11.5%. Margins have inched up now, and I'd want to know the reason for that. ROAs, largely again stable. Just look at the stability on the ROA. Look at the stability. This is of course Q1 FY26 on your screen. Very, very strong numbers. But let's switch focus. Let's look at the 3-year picture. And on the 3-year picture, you'll see far more stability in terms of where the numbers are. There you go. The ROA number fairly stable. 11.23% is incorrect. The FY24 ROA is 5.84%. So between 5.7 to 6% is broadly the ROA range. And when you're looking at yields as well, it's been largely stable. It's not been too choppy. The cost of borrowing has certainly gone up as a result of the repo inching up between FY23 and FY25. Spreads also have largely been maintained. That's the better metric to look at it. So again, a thumbs up. It's tough to have that kind of stability in a business like this, in the lending business, and we've seen that. Shareholding pattern, and when you're looking at the shareholding pattern, fair bit of stability there as well. Lots of skin in the game that promoters have, and therefore we've given that a thumbs up as well. 73% owned by the promoters. FIs have a decent amount of interest, so do DIIs. Very small public interest in this one. Let's talk about the street cred now. In terms of returns, 1 month there's a 4% return, 3 months 23%, 6 months again 23%, 1 year you've seen a 52% return on the stock price. But the 5-year stock price is up just about 2.2x. So you've done maybe around 16% or 17% in terms of returns, which is fairly healthy. But when you compare it to the benchmark and what the benchmark has done in the last 5 years, mind you, compared to 2020, of course, there's been some bit of underperformance. And therefore, again, on the street cred point, we've given it a neutral. largely because the 5-year performance hasn't lined up as well with the index as ought to be. Let's look at valuations now. And when you're looking at valuations, you look at a Muthoot and largely look at a Manappuram, right? These are the two largest gold lenders and therefore businesses which are more comparable. You look at Muthoot, much higher priced in comparison to a Manappuram when you're looking at the multiple, right? But the multiple shrink is going to be extremely large. So 1 year forward price to book is just 3 times versus the 4 times number currently. You're going to see that shrink largely due to profitability coming in. And second, Muthoot has been relatively more stable compared to peers in terms of performance as well as in terms of the way it delivers profitability and ROA. So all of that helps it stand out in terms of the multiple that it commands in the industry. So surely something that you want to look out for, but surely something which is slightly expensive compared to peers. You also want to keep in mind that the ROA is 5.5% plus for a 3-time book, 1 year forward book company. So that's the other piece you want to keep in mind. But of course, we will try and get a better perspective from the management on what they think. This is street coverage now. 15 buy calls, 6 hold calls, 4 sell calls. Average return is -3%. Given the buy calls that are there and given that we might see tweaks with regard to target prices as well, already starting to see that, we've given this a neutral as well. But largely the upside, according to analysts, remains capped, at least for the moment. Let's sum it all up. Let's try and put it all together and give you a full picture. No thumbs down. That's the one piece which really stands out. But outside of that, you've got all of those neutrals and thumbs ups, giving it a 6 out of 8 on the KYC rating. Let's go across. We have George Alexander Muthoot, Managing Director at Muthoot Finance, joining us. Pleasure, sir, speaking to you. This is Harsh here. Let me first start off by understanding this very strong loan growth that you've clocked, 40% YOY, 10% QOQ. How much of that attributable to the increase in gold prices and how much of that is actually attributable to new customers and existing customers taking new loans? Give us that perspective.
Thank you. Thank you. So in the last 3 quarters, we have seen good growth coming from good demand coming for gold loans. I think the demand is the most important thing here. The demand is coming mainly because gold. One is the availability of funding. The fund availability with people in the last 2-3 quarters have been low, especially with regard to unsecured lending. The regulator, etc., has been actually cautioning all banks and NBFCs to reduce unsecured lending, especially the personal unsecured loans, the microfinance loans, and even the credit card loans, etc. The Reserve Bank has been cautioning. As a result, the availability of funding has been low in the last 2-3 quarters. So people have chosen to take more of gold loans. And the gold price, which is already about 40% high in the last 1 year, there is always, every day, at least 3 news items in the newspaper about gold price, about gold loans. So people are now getting more and more interested to utilize the ornaments they are having to take a loan. That is the demand part of it. The second is the gold price. Personally, people who are able to get a lesser amount earlier can get higher amounts today. But not necessarily that everybody should take the maximum amount available. Today, if you look, our loan to value, although we are able to lend up to 75%, it is only 60% of today's price or 61%. That means everybody has not borrowed the maximum 75%. People will borrow only to the extent they require and they feel they can repay. The third point is again about the regulatory regulations. The new final regulations which came in maybe in a month back is, if you ask me, it is quite gold loan business friendly. It is gold loan business friendly both from the point of the customer and from the point of the lender, whether it is bank or NBFC. In fact, today a loan up to 2.5 lakhs, the new regulation says can be given with least formality. And that is what I think people need. And that is what I think is what the finance ministry as well as the Reserve Bank, the regulator, want. That is a clear signal that this gold loan business is being favored and maybe favored by the regulator. So these three things which work together in the last 2-3 quarters have been responsible for the good growth in the gold loan business. Not only
Understood.
for Muthoot Finance, but also for many banks and other NBFCs. Of course, Muthoot Finance was able to do better because we have a 5,000 plus branch network all over the country and a 30,000 dedicated staff. So that is the reason why the gold loan growth has come.
Sure. So let me ask you what the expectation therefore should be in terms of loan growth. All of this aiding your numbers, FY26, you've guided 15%. Does that change? That's my first question. Second, for an investor who's going to hold your stock for the next 3 years, what's the growth expectation that he should pencil in?
Yeah, of course. Our job mainly is to run the company well.
Yes.
Run it to the satisfaction of the regulator, the customers, etc. And of course, as we run a company well, as we deliver good profits, etc., the second corollary is that the share price also goes up. So we are, as I heard you say, that the promoters have the skin in the game. We have, when we went public, we divested 25% and 75% has been with us. We have not sold one share till now. The 1% or so reduction you see is because of the ESOPs we have given. So we as a company, as a promoter or people running, we stand not much to gain by the share price. But then rewarding the shareholders is also definitely something which we need to do, and we have been doing it. So I wouldn't be able to say what the price will be after 2-3 years, etc. About the growth.
Apologies. I think you've got my question wrong. So I'm talking from a loan growth perspective. FY26, what is your guidance? Does the 15% guidance change, sir? And second, what should an investor anticipate in terms of growth? You've guided 15, but you've done 25 last couple of years. Is that now the new 15% for you?
So over the last 5-6 years, we have always guided the market start in the first 2 quarters at 15%. We usually do a change only after the second quarter. In last year, we guided for 15%. We did a 40% growth. Prior to that, we again guided 15%. We did a 25% growth. So we have always overdone what we have guided. So today, at this point, I wouldn't want to change the guidance. Just really there. But I'm pretty sure we should be doing much better this year also.
Sir. So with regard to margins, what's aiding it? Is it the credit rating getting better? That's what's aiding the margins. Is it the fact that there's more gold lending to existing customers? Is that's what's aiding the margins? Give us a perspective.
So the margins actually, we have a net spread of 9.2, 9.3, 9.5 over the last several quarters. If you look, our spread is always 9.5. This quarter, it was higher, mainly because there was an increase in the profits, which I'll explain right now, is having only for this quarter. We had a write back of about 700 crores of NPAs, which customers came, took back the gold. These are not the hardcore defaulters. It is just people to whom we gave time to clear the gold. When we gave the time, it became an NPA, noted as an NPA, but when they took it back, it became a normal loan. So all these 700 crores people, they came, they took back the loan. And when they took back the loan, they gave the accrued interest, which we had derecognized at the time of putting it as an NPA. So about 275 plus crores came from there. Another 100 crores we got because of the ARC. We did an ARC about a year back. We did about 700 crores and 60,000 customers gold we were able to keep without auction. Now in the last 1 year, they have all started taking back the gold. And by the last year, we got back all the principal. Today, whatever is coming is interest. So we got a 100 crore interest this quarter. So
Understood.
these two get the bump in the profit. So,
Understood.
but going forward also, our spread would be in the same 9.5 range only.
Understood. So, blue sky quarter for you. I have just 20 seconds left. Blue sky quarter for you. Can you continue to do maybe 6.5% plus in terms of ROA, or is this just a one-off?
Again, we always guide for a 3 to 4% ROA. We always do 5 to 6. I think hopefully we should be able to do well, but I wouldn't give a commitment like that. Always when we commit, my CFO and me, we say 3 to 4% is reasonable. It's good also, but always we try to do more than that.
Understood. Okay, thank you so much, sir, for coming in and speaking with us. Viewers, completely out of time on this edition of KYC. Thanks so much for tuning in. It's a goodbye from all of us and wishing you and yours a very, very happy Independence Day. Have a great weekend.